Assalamu alaikum. Okay, so my name is Ruqayya Khan. So, like I'm accountant and I'm certified professional accountant. Is it better now? Yeah, I think it's now. Okay, now it's on. I think so. Okay. So basically, Sabine, she invited me, asking me, there was a sisters get together and I have to speak something about tax because tax is around the corner. So we were very busy because tomorrow is the T4 filing deadline, but because she said and I said, okay, I couldn't say no to her, so we just arranged a small get together here. So basically, I will not take too much time for my introduction and stuff, so I'll just explain, go to our topic. So basically, I just picked some like a really common people a question to ask about, and nowadays people more ask about like taxable income and then how to save the tax, and too much people are not buying and selling, and they talk about the property, principal resident exemptions and all. So I just picked some of the topic which I think it will be best serve your interest, but if you will feel like after my presentation, if you guys have some question, I will be happy to answer your question. Okay, so basically, so when we talk about, everybody talk about like how we can save the taxes. Okay, so everybody say like we want to save the taxes. So the government imposed the taxes, not that everybody can save it by any ways. Okay, so only the thing is that we have to work on something to mitigate like consequences as hard they push us. Like for example, if you are you have two properties and you want to sell it, so we recommend just spread it over a few years to better not pay tax on lump sum. So the reason is that individual tax are taxed on the aggressive rate, like higher the income, higher the taxes. Okay, so that's the reason we sometimes think like if we have everything together, we are paying the higher taxes. So basically, what is like what income we are paying the tax? So basically, when you are working, so for example, one taxpayer is employee, and then he's also have a business, and he also sell some property. So everything jump into his that year tax return. So that's what, because it's threshold of the tax rate go higher, and he end up paying the higher taxes. Okay, so basically we talk about the taxable income. Okay, so basically we pay tax on our taxable income. So taxpayer income from all the sources, okay, from the self-employment business, employment, capital gains, investment income, interest, dividend, everything get together and call like all total income. So everybody usually serve on their notice of assessment line 1500. So total income. So basically that income is not taxable. Okay, this is just the total income. Then we have our Division E deduction, which called deduction. Okay, so for example, you contribute an RRSP, and tomorrow is the RRSP contribution deadline. So you want to basically lower down your, because total income after deduction is become our net income, and then we have some sort of a special deduction, and then it's become our taxable income. So we pay tax on our taxable income. So we want to reduce or defer our tax by the deduction. So different people has different deduction. Okay, husband and wife working, they have a child daycare expense, or they contribute an RRSP, or some employees, they work from home or travel for their employment duties, so they have employment expense. So those are the deduction, and after those deduction, we got our taxable income, and our tax rate imposed on that taxable income. So we always be like looking forward to reduce our taxable income. So here I will just explain you about the tax credit and tax deduction. Okay, so we save taxes by two major categories, deduction and credits. Okay, so basically deduction directly reduce our taxable income. Okay, if my income is 100,000, and if I contributed in a RRSP, so RRSP is basically give me tax deduction, deferring my tax for future years. So my income will become 75,000, and I'm ending up paying taxes on 75,000. So these are the deduction. So how deduction work? the higher the income of the taxpayer, higher the tax bracket he in, and higher he can save by deduction, because deduction reduce his taxable dollar on the rate he's paying the taxes. So deduction is different. For example, if my income is 40,000 and I contributed 10,000 in RRSP, I might be saving a very less because my tax bracket is maybe 12, 13%. So whatever the dollar amount I have contributed in RRSP, I'm just saving 10, 15%. But if somebody has 200,000 income and tax rate is 33%, if he contributes 10,000 in RRSP, he is saving at the rate of 33%. So deduction are basically depends on the income and higher that which bracket you guys are. So I see many people, they rush into buying the RRSP. When one of my fellow, he's like in the financial services, and he said he got a client and he was insisting that I want to put it in 100,000 in RRSP, I want to save 30,000. He was asking him, go to your account and check what bracket you are in, what's your tax rate and all those stuff, but he was. So basically sometimes we find some clients, they rush to buy RRSP when they go to bank. Bank always like people, they buy the RRSP, contribute and buy, because they want your money from you to invest, and they make a more higher return, and then they give you just tax deferral things, okay? So basically you have to know, I see so many people, they just, income is 30, 40,000, but they go just, okay, we want buying our first home, why not we just go RRSP contribution. So not everybody can save while doing the RRSP contribution, because it's just the deduction. Vice versa, we have a credits, and credits save everybody's tax by the same amount, because credits reduce our tax liability. Once we have our total income, after our deduction we have our taxable income, then we calculate our tax according to our tax rate, and when we know that our tax liability, and then whatever the credits we have, for example, basic exemption, our tuition credit, okay, spousal amount, or whatever the credits we have, by that credit we reduce our tax liability. So tax credits serve for equal amount for everyone, but tax deduction give everybody different type of tax saving. Okay, so that's basically we have to understand we are doing our credit or our deduction. Okay, so basically that's, so usually when employees comes to us and they says like we want to save our taxes, okay, so we are like, with the employment we are pretty much very constrained with the tax deductions, okay. So basically we have, if you have T2200 form from your employer that you work from home more than 50%, or you travel using by your own vehicle and stuff, so you can claim employment expense, you can contribute in a RRSP and stuff. These are the very small deduction we can go for when we are talking about employee, okay. So, but here I'll tell you what, even if we go for the RRSP contribution, we talk about more if one spouse income is lower, we always ask for the spousal contribution, okay. So when you withdraw from the spousal RRSP, eventually it tax on the lower spouse income. But here again we have some of the tricks from the government, okay. So for example, if I have 100,000 income and I contributed 25,000 in the RRSP, so whatever the tax I deferred, whenever I will pull 25,000, I will be pretty much in the same bracket, and when I'm be pulling that amount, I'll be paying the same tax, okay. So but if my spouse is not working or has less income, if I contributed through the spousal RRSP, okay, and if after keeping 3 years in the RRSP, spousal RRSP plan, when I pull my RRSP from the spousal plan, it will be taxed on the lower income spouse, which is my spouse. But here they have one trick, okay. So they say, okay, if last 3 years, whatever the contribution you made in a spousal RRSP, it will be first considered that amount was the withdrawal. So for example, if 10 years before I contributed 10,000 in the spousal RRSP, and every year I'm contributing 1,000, 1,000, 1,000. If today I'm withdrawing 10,000, so 3,000 will be considered my income, because last 3 years I have similar contribution in the spousal. So whenever you want to pull anything from the spousal RRSP, better to put gap for 3 years at least, and then whatever the amount. So we suggest our clients, so if for example sometime they are selling the property, plus they have on the high bracket because of their employment income. If they have to contribute an RRSP, do the spousal RRSP, okay, and then try to keep, like don't put anything in the spousal RRSP for 3 years, and then try to pull that amount slowly. So that's a few technique we can just work out in this employment income. Okay. As the other hand, businesses can claim more expense. Okay, so for their travel, if they're going to meeting the clients and stuff, and meals, office supplies and stuff. So business can lower down their income while eligible expense they are incurred to earn that business income. But for employee, we are just pretty much the child care. And even for child care, if one of the spouse is available to take care of the child, then we just, even if our sending kids, child daycare is not give us any deduction, because if lower income spouse is available to take care of the child, and lower income can claim the child care, so it will be, at the end, it will be just nothing. Okay. So basically, that's what is, but every business, like tomorrow is the RRSP deduction, RRSP contribution day, last day, we can contribute. And so many people are rushing, and they are not looking at their taxes, what bracket they are, and they just want to RRSP. Our banks, our government, everybody like explain, even if here instead of me there's any financial advisor, he was be asking everything very good about the RRSP. But for myself, I never liked the RRSP. So here, that's why I thought I'll just give a little bit information on the financial literacy side on the RRSP. So basically, when we get the client who are senior now, and they want now reaching at the age of 71, where now they cannot contribute anymore in their RRSP. Plus, at the age of 71, you cannot contribute anymore in RRSP, and your RRSP plan deemed disposed of. Meaning, if you reach today at RRSP, you have to, today's date, you have to tell the bank before that, okay, it's, you want to convert in the RIF program, which is the dad of the RRSP plan, or you just want to pull and pay tax. So for example, if last 20 years I was contributing an RRSP and I have 200,000 or 300,000, if I want to pull my money because I want to spend a very good senior life and stuff, but I will see that half of the money is gone to the taxes. Okay, so, and we were waiting for 20 years, and RRSP, bank, everybody say, oh, it's a tax saving. It's not tax saving, it's tax deferring. And somehow you end up paying more taxes. Okay, it's really common that you are paying even more taxes. Okay, so how? Because if 1980s, somebody started the work, start getting, paying an RRSP, now 200,000. If he's at the age of 71, try to pull, half of the money goes to the taxes, because at the end you will be in a higher bracket. They tell you that, okay, because at the, after 65 or 71, you have a less income. But so many of us, they have very good jobs, okay, so they have their company pension, then the old age benefit, then their CPP pension, everything, they are. And so many people, they rent a property, so they have a rental income. So at the end of the day, you are still making some money. Okay, so you are not like just like your bracket is not go down. Usually who work that high income bracket, that they have to contribute an RRSP, even after retirement, they have sufficient income. So that at the end of the day, your tax bracket is not that lower. Plus, if you don't wanna take it all together, then you have to convert into RIF, and it will make an annuity payment that every month you will get a certain amount. You cannot cross that amount. Okay, so you just like are waiting for there to utilize your money and like end up like you pass away from this world, like not getting your income in your hand and enjoy that income. Okay, so and other thing which more concern is the time value of like a present value of that money which we are pouring in that RRSP. So if 1980s, 200,000 was you can buy the house, but now 200,000 is not sufficient for down payment. So whatever at the end of the day you are getting, your money has no value. Okay, now half of the value of the money is now gone. Okay, so you were very happy that you are putting an RRSP 25. I see people 75,000 putting an RRSP 45, but it's at the end of the day you will see. If you will wait till 71, pretty much you lost everything. Okay, so then another one is people, even if you put it in RSP, you like it, that's fine. But then you have to plan. When you are reaching 60s, I recommend that start pulling some amount. Spread out that big chunk over the years. Okay, 10, 15 years start. And even in between, whenever you are on, like you work less, you are layoff or something, start taking out from that RRSP money. Spousal RRSP help in the sense that you can just take some income if your spouse is, has a less income, so you can just mitigate. But that's the biggest problem with the RRSP, which I don't like it. And for my family, even as an accountant, I never put it a penny in the RSP. It's better to pay taxes and use your money because this is yours after taxes. Okay, just sometime I can say, for example, your income is high and now you sold the property and you know that this year with the taxable capital gain 100,000, your income 100,000, you are really in a high bracket, but next year you will be usual your employment income. So you can just use it for the short-term measure, put something in and then just start taking out. But I don't recommend that. Yeah, if it's anybody here from the financial sector, they might not like it, but that's what it's my. But still, yes, so many people already, yes, yeah, yeah. But another thing which is here is still I recommend for RRSP for the young people. They're starting the jobs, having a good income, and they still have to buy their first home. Okay, so so they allow, before it was 25,000 against the home buyer plan, you can withdraw RRSP, not immediate taxes. If a regular basis, if you pull anything from RRSP, right away all the money is taxed. If you pull from the RRSP against home buyer, it's just 2 years, it don't show up in your income, and after 2 is divided by 15, is eventually you have to pay tax. Still, because the new generation, they are worried about how they will buy the house and stuff. So I recommend, okay, if you can go up to for 35,000, you can go have in contribution in RRSP, and whenever you have your first home, you can just withdraw it. So here I will explain also the TSFA account, tax-free saving account. People think it's like a RRSP, but it's not like a RRSP. You don't get deduction. Whatever the amount you have in the tax-free saving account, whatever return you earn on it, interest or dividend or whatever, it's not taxable. Okay, but so many people are, we are very not risk averse. So whenever we contribute or anything in the saving account, we want them to less risky stuff like, so mutual funds and government bonds and stuff. We don't want to okay, higher return, higher risk, so we want to. So at the end of the day, we are not making that much amount on that tax-free saving account. But still, if you want to save something for your future, it's don't give you deduction, but the money is over there. But again, maybe you have lots of better option for that. So tax-free saving account, one thing I see so many people suffering with, over limit contribution. Like a RRSP, whenever you pull your RRSP, okay, so it free your room. But tax-free account, whenever you pull from the tax-free account, next year it's get on the usual. And so many people, if they max up their TSFA, okay, and then November, December, they said, okay, we need 5,000, take it out from the TSFA. So now remember that you already max up this year. If you are taking back 5,000 from your tax-free saving account, don't think you have a room again to put it in. So same year, you cannot put it back your 5,000. And I see paying lots of people a very huge penalties because they put it back money and then it considered over contribution. Because the room refresh for the TSFA next year. Okay, so if already max up, then if you are pulling some, don't put it back and wait for the next year. This year in the new, because there's so many complaints about the buying house and savings, so they introduced his FHSA account, which is first home saving account. Okay, so here they mixed up the attribute of the RRSP and tax-free saving account. So basically anybody over their life period, they can contribute up to 40,000 in FHSA account. And unlike TSFA, you get the deduction for FHSA account. So for example, before December 2023, if you contributed 8,000, okay, so you can get the deduction, okay, and you can wait 2-3 years if you put maximum 40, and again you withdraw it from the FHSA account, you can use it towards your first time home buyer. And but this, unlike RRSP, it's after that it's just finished. Once you withdraw eligible withdrawal buying your first home, it will be finished and no more you can contribute it. Again, this was the first year, and I see 1 or 2 clients, they come up, they went to the bank and they say, oh, can we open up the FHSA account? Said, oh, you have a home? He said, like, yes, I have, but my wife, she don't have. The house is on my name. And bank said, okay, right away, you are eligible for FHSA. When they came to me and I said, how come you open up the FHSA account? He said, bank say, like, I'm eligible because that house is only my name. So first of all, the principal home, the home is for husband and wife, the same home is for everyone. Even under 18 or unless your kids are married and have a separate home, all principal resident and home consider where they live with you. Okay, so doesn't mean the home is on your name, and it means you just like now, if you have husband and wife has one home, so means your first home criteria is finished. So another thing is, so many people when they invest or buy the house, they put their kids' name in there. So that's another, people are always very confused. So if I need, I was getting hard time with my mortgage and I say, oh, my son is working, it's a little bit income, just add him in my applications and stuff like that. Okay, so even if it's the property where you move in, so it will be considered your kid's first home as well. So while taking this decision, be careful, don't ruin his first home condition and stuff. But if you are adding his name to investment property, so word home is really important. Home buyer, first home tax credit, and all this is for home, where you live in. Okay, this all like a first time home and tax saving and tax credit and everything is don't apply on your investment properties. So but if you have an investment property where you added your son name and everything, so that means he still can have his own home where he can claim first time home credit, first time home land transfer, and also he can contribute. So basically the matter is the home where you live in, okay, your principal home. So basically that's the one we can use it. RRSP, yes, until first home buyer I recommend. After that I said like a slowly, unless you have some year where which is a very exceptional cases where you have 2-3 properties you sold, or somehow you have a jump into high income or high bonus or something like that. Retirement pension plan, which is the kind of the RRSP but is through your work, is little different because your employer matched the RRS pension over there. So that give you little bit benefit because even though you are contributing in a retirement pension plan, but because your employer is matching, so you might go with that. That's a good option. Only thing is that if you will resign that job, okay, there is a with your employment contract, it says like after 10 years or after 15 years, whatever is the time when if you will resign and leave, so you will be basically all retirement pension will be vested, which will be your employer portion and yours. So for example, if I join within 3 years, if I will leave the company, I can take only my retirement pension amount which I contributed. The amount which matched with my employer will not be with me. So basically its employment contract says whether after 10 years you have a right or whatever. But again, because it's until your retirement you cannot withdraw money, and it goes to another, you just transfer to your own RRSP and stuff if you are changing jobs. Yeah, locked in is always be locked in, yeah. So that's the basically you can go from there. Yeah, but this is basically things we talked about, the tax-free saving account and RRSP and stuff like that. So any question up till now? Yes. Yes, that's I'm saying you have no way out.
If I take like 1 or 2 payments, that's okay, you have to pay taxes.
No, see, at the age of 71 you have to decide either taking all or either transferring to the RIF. So basically RIF is a plan which they talk about that, okay, according to your funds in your RRSP plan, that will be your monthly annuity, not more than that. And you will be just restricted with that. Okay, and if you will be taking more and stuff, so there is a penalties and stuff. Okay, yes, a good thing is that if, for example, if we say, oh, we pass away, what about our this RIF program? So basically within the spouse is just rollover. Okay, so it's basically rollover to the other spouse. Okay, after if other spouse pass away, so according to whatever your beneficiaries are, your kids or whatever, they go to them, but now you have to, whatever the amount will go to them, the deceased return will pay tax on it. So basically at the end, they will get after tax. Yeah.
Second question is also regarding this one. Like you have RIF, right? So if you want to take out like not the whole amount, like suppose it is 1 million, so you want to take out like maybe 10% or that kind of thing, then there's a different tax rates for that, or it is same rate like 20% or something like that?
Okay, so we always get very confused with when we withdraw anything from RRSP, they withhold the taxes. So basically that is just they withhold in case, for example, I had 100,000 in my RRSP. I took, and if they never withhold any amount, and if I took, I'm just leaving Canada, so I will never file the taxes and not pay taxes on that amount. So that's why they withhold. So if you are taking less than 10,000, they withhold 5%, and then up they take 15%. So even if you don't file tax, they have your withholding money. So basically that is withholding only. But what will be bracket you will in, that will be your tax. So when you will at the end, and for example, you took 100,000 and they took with 25% taxes. But now you have a rental income, you have employment income, and your tax rate is 35%. Okay, so at the end of the day, what they withhold it, top of that you will be paying the taxes. So basically it depends. So that's why I'm saying you have to plan. Even if you have something in RRSP, whatever year you have a less income, you are not working, or you have a layoff or something, so you take some money. Okay, but that's another problem is that some people lay off and then they go for EI. And then if they withdraw from RRSP, they end up paying again more taxes because now they have a EI plus the RRSP. So I saw those cases where like taxpayer is like, I was thinking, what is that? Like EI money is not enough for me to paying everything. And if I pull money from RRSP now, or at the end I'm paying everything on the taxes. So that's I'm saying, like at the end of the day, it's not tax saving, it's tax deferring, but sometimes it's more taxes. Okay, so that's basically the thing is that. Yeah, okay. Any
Thank
other?
you.
Yes.
Person. Should I say the question
So
again?
that's what I'm saying. See, that's my first, I explained that if Canada Revenue Agency want you to save taxes, why they impose taxes? So there is the taxes because we have to pay. They cannot run. Okay, so we have to prepare that. So when my clients come, I educate them that basically see around we have a road, we have hospitals, we have water, we have electricity, we have all the things. So this is our tax money going in. Yeah. So basically tax is just like we cannot just save it by every mean. Okay. So that's what I'm saying. We can just plan it like I said, if you want to RRSP, if one spouse is not working, you can get something with the spousal RRSP and then plan it that, okay, you will withdraw. But you have to do all the planning, okay? And even if you have RRSP, then the age of 55, 60, start pulling some. So, but at the end of the day, we are not certain about our death, okay? So for example, if I die, okay, and if I didn't get a chance to spread my RRSP money over the few years, everything comes to my final deceased return and it will be paid taxes, and after taxes then it will go to my beneficiaries. Okay, so the thing is that like this system is the banks, the return, the interest, and they need your money, okay, to invest, and they get the return. And they just give you the tax deferral, okay. So I said, yes, you can plan when, for example, you have like unexceptional situation where you sold the property, you have a high income, yes, okay, this year. And even if regular basis is small amount, okay, but not go like that you are just transferring all your income over there. And because even I get so many calls from the banks and stuff, you said like I'm not very fan of the RRSP. They says, oh, if I will suggest my client RRSP, they will give me commission. I said, but that I didn't like for me how I can advise my client. That's what I'm talking about. Maybe some of you didn't like it, but the thing is that if at the end of the day, we have no control over our death. We don't have control on our at the end of the situation, and that money we will utilize, and then inflation and everything make our money so valueless at the end of the day. Okay, so but again, if you have a spouse contribution little bit over here and there, you can just go for that one. Yes, but not too much in the employment. Then we said like another option is that like if you are starting like working more towards a business arrangement or corporation arrangement to get like paid in the corporation or self-employed or contractor. But as an employee, we have no other choice. Okay, so we are very restricted. Even if you will claim a little bit more employment expense, audit will come and say, well, where you spend this money, you have a T2200 form, what you can, did you maintain the logbook, and all those stuff. Okay, so basically that's at the end of the day, we have taxes because we have to pay taxes, not to avoid the taxes. Okay, and they just bring it up to run our banks, our all mechanism of this system. They have this RRSPs and all those stuff. But here I said for the new people going to work after finishing their studies, looking for a home buyer and stuff, yes, you can go for up to 35,000. Now we have FHSA account, you can go over there like a little bit. But for my experience, I said pay the tax, and now I know whatever this after tax money, I can look for the more plan where I can invest. Okay, some small businesses, some properties, okay, stuff like that. We can always go with that. Yeah. Okay. Any other question? Otherwise, I'll go to the. Okay, so now, okay, oh, yes. So now I'm just a little bit talk about the what's new for 2023, because tax season is around the corner and a little bit changes due to COVID. Last few years we were claiming the people had the benefits and stuff. They also have deduction, home office standard deduction and stuff. So this year we don't have those. Okay. So basically, there is a one thing that if you are fall on the low income, okay, so there is a Canada Workers Benefit. So this time everybody is getting RC201 slip, and they are asking what is that slip. So basically, it's the advance payment of your low income benefit, which is the Canada Works Benefit you are receiving. So basically, it's advance payment coming from the government. They changed a little bit this year. Okay, climate action incentive used to be with the tax refund, but now it's coming as a separate quarterly payments. Okay, so many people from us, they are trade persons. So government allow in their tax deduction that they can claim the deduction of up to $500 of tools. If, for example, I'm a handyman and I buy small tools, I can deduct $500 on tool. This year they increased to $1,000. They have a similar for teaching supplies as well. Okay. People who caught by the government asking to repay their benefit and stuff, they are also getting slip, and now that will be deduction against their income. Okay. First home saving account, we already talked about. This is new for this year. Okay, the very good one is here is multi-generation home renovation tax credit. Okay, so this is a new credit if you are building a separate unit in your basement or something. Okay, and for your family members, for maybe your son is getting married on something. So eligible expense up to 50,000 you can claim. So where we says the credit, usually credit is work, for example, this says up to 50,000, and people say they can save 50,000. No. The 50,000 is the credit limit, and because our tax rate start from 15 50%. So 15% of 50,000 will be basically your tax saving. So it's around 7,500. Okay, if you fulfill all the eligibility criteria and you are building a separate unit in your home, you can claim that expense. Property flipping is a very big thing this year because so many people are up to buy and sell and all those stuff. So I put it as a separate topic. I'm going over there, there's a few things. Okay, fuel charge also on farmers and self-employed is new for that year. Okay, and the temporary flat method, which was the home. So due to COVID, people working home, there was a 2 method, detailed method. If your employer give you T2200 form that you can deduct the expense, we use the detailed method. And if you don't have the T2200 form, last 2 years we were claiming a straight 500 deduction from our income for the home office expense. This year they removed it. If now anybody works from home, they ask their employer, they want T2200 form. And also the condition is that more than 50% of your employment duties, if you are performing from your home, then you will be eligible to claim the home office expense. Also employment expense, if you drove your own car for your work related, okay, and your employer is not reimbursing you the mileage for 55 cents per kilometer, then they give you that, or maybe they are giving you allowance, okay, adding in your T4, so then you can claim the expense over there for employment duties. So here we have anti-flipping rules for residential reassess. So many people try to say that, oh, I have a house I'm selling, but that's my principal. This is my first home, so maybe I can deduct principal resident exemption. So for example, if I bought the house, but as I'm renting a place, but I bought the new house, but I rented out that property, I'm also living on rent, but what the first house I bought, I'm renting somebody and I'm getting the rental income. If I'm selling that house is investment property. It doesn't matter you have one home means that is your home. Okay. So in Canada we have a principal residence exemption. The house you maintain home, your family lives in that house. If you sell that property, whatever you bought and whatever you sell, whatever the gain you have, it's exempted through principal resident exemption. Okay, but that means you have to live in that property. It doesn't mean that you have one house and this is because it's only one house, that means it's your principal residence. Okay, the condition is that you should be living in that property. Okay, so many people they think like, and so many people confuse that, okay, this house is on my name, so my wife has another investment property, might be is my wife. They think they will change the mailing address to that properties and then the government. Nowadays government is going, because there's a loss of money going on the capital gain and buying and selling. So they are looking at MLS listing and everything, who is selling, who is buying. Okay, and that's why even in the tax, like this year, every year they had, like the last 3 years there is a question, did you sold any property where you are claiming a principal resident exemption? 2-3 years before this question was not there. Okay, government was least bother asking, did you? And we were buying and selling the houses. But when people started jumping into, especially so many people, they just bought the property, renovated. They even live in that property, renovated 2 years, 1 year, they sell, move into new property, renovated. So basically they find out the way that, okay, if the condition is to live in that house, let's live in that house, upgrade, when price go up, sell. And then they start moving. So when the government know, now they put this question, okay, did you sell this year a property where you are claiming a principal resident exemption? And you said, yes, I sold one property. Next year the same question, you said, yes, I sold the property. Third year, then the audit will come. And then they will ask you, how come every year you are changing your principal resident? If you have a good reason, for example, or you were living in Markham, you got a job in Ottawa, you have to move. Or second year you have to go back to the Markham again, you moved. So if you have a valid reason where you can, that your purpose was not to make money, but because of your moving, you were just, so that's why this question they embedded with your tax. And if you say no, no, even you are selling the house and you are saying no, now they are getting, even you see when if you are closing the house or the lawyer is sending and you getting a sign from you that there is information going to the Ministry of Ontario, okay, and they are keeping eye on that, okay, this person sold the property was never mentioned. Okay, maybe 1 year to millions of people filing, sometime is late we caught up, but eventually. So that's the basically people under the principal resident exemption, so many people try to misuse it, and they used to, like their purpose was to buy and sell the property, but they said, okay, if the rule is to we live in, let's live in that property and after 6 months upgrade and sell. So basically they caught up. But after now what's happening, so basically there is in Canada we have capital gain. So capital gain is taxed 50%. So if I bought a property for 100,000 and I sold for 200,000, so I made 100,000 net after paying all the agent fee and stuff. So now this 100,000 is my gain, but only 50,000 is taxable, because we have a 50% inclusion rate of the taxable capital gain. So people now start misusing that one as well. Okay. So capital gain means that I bought a property, I invested my after tax money in there, keep it for so long, 2-3 years, my investment grow, and then I sold it. Okay. So I have, so the government gave that 50%, that okay, 50% of the gain you don't pay tax on, only 50% of the gain you pay tax. The reason of that was because opportunity cost you were losing on that, like 300,000 you put the down and everything, and now waiting for 3-4 years, and after when you make money, now everything is on taxable. So that's why government says, okay, so we'll just, and they encourage the investment in the country. So basically our tax policies are embedded with our physical monetary policies and stuff like that. Okay, they see if we want to grow investment in our country and stuff, okay, let's capital gain 50%, so people save and put more onto the investment side. So, but now if you are, so for example, if I'm selling something, any inventory, and I'm paying tax on my full income, and you are selling the houses, and you are paying only house because you are saying it's capital gain, and I'm saying I'm selling inventories, my business income. So I will be said, why? Like you are also buying and selling. Okay, so it means now you are just working as a business. So that's the major reason this difference between tax on capital gain is only apply on half of the gain, and tax on your business income is apply on your 100% business income after all the expense. So people, the government has noticed that people are using buy and sell activities of the houses and stuff as a business. They are buying and selling, but claiming the capital gain. Capital gain is work when you keep few years and then get the return. Okay, so there is a big difference. Okay, so if I have a tree and I have selling the apples are my inventory. Okay, so whatever the profit I'm getting is my business income. I have to pay tax on it. But if I sold my tree, okay, so that is my capital transaction. So whatever the money I'm making is a capital gain, which I'm paying only 50% of the gain. Okay, so that's why. But when people use this transaction as in a business, okay, so then the government say, oh, so that's the few reason they put, are you selling the property? So when we say, so many people last few years was got audited, because the government see their every year they are capital gain, they are selling the property. So they said, why, what was the reason? And the criteria is that, okay, are you real estate? Okay, are you have something to buy and sell? Okay, are you developer? What type? Are you, like if I'm the doctor and like after 2-3 years buying and selling the property, they know it's not related to my field. So might be is a capital gain. But if all your intention and everything is supported that you are doing kind of business, then they treat it as a business. Okay, so they are now catching up all those people every year if they are buying. But now because of this assignment sale and stuff like that, too much, they called it flipping. Okay, if the flipping was always there, that if you flip property, so this is not capital gain, is the business income. you have to pay tax on the full amount of the income you made. But because of the people motivation from last 2-3 years, now they more emphasize this, okay. So they are now putting in the taxes. Are you sell the property here within the 365 days of your buy and sell? So now they are clearly saying, even if your principal home, if you will sell it within 365 days, it will be considered flipping, not even capital gain. It will be taxed on the rate of, like I said, regular income. No 50% tax exemption will be given, unless again if you have something like if husband and wife bought the house but marriage broke down, or something happened, somebody got ill or they couldn't afford, or something like could be they have a criteria over there. But if they see it was just your own choice, then they will be asked, is flipping. So even not capital gain level. So first level is that I sold the house, is my principal residence, I'm not paying taxes. Another is my investment property, as I'm selling, I'm paying tax on only half of the capital gain profit. But the third is that is just the business, whatever you made it is all taxable. Okay, so this is the business income versus capital gain. So people just try to a little bit arrange transaction like that is considered as a capital gain, but now they are becoming more tough and tough. So we have to be very careful. And I suggest everybody that try to keep it for 365 days. Don't rush to sell it, even if you buy it for investment. But first of all, you lose your rental property rebate or new housing rebate, which is around up to $25,000. You will lose that. Okay, if you booked some investment property, you are rented, you can claim a rental property rebate, which is around 25,000, and then you can after 1 year or 2 years, if you will sell, half of the capital gain you save under the capital gain exemption. But if within 365, you will lose all these two transactions. So the basically flipping is like they are triggering more nowadays. So any question? Yes. If you are paying mortgage, yes. So basically, whatever the money you make, whatever the expense which is incurred to get that income is deductible. If you are doing business, I'm selling the chairs, I'm buying the material, I'm using my car, I'm advertisement or whatever. So those are eligible expense. They are helping me to make that money deductible. Same as the houses. If, for example, you are paying mortgage, not total mortgage, whatever your principal, because it will be recovered, mortgage interest, insurance, and property taxes, repair and maintenance. Here people are very confused with the repair and maintenance and the capital renovation. Okay, if you said I'm renting my house, but I did the basement as well now, separate entrance and everything, now I'm can I deduct as a repair and maintenance? No. Repair and maintenance meaning something broke down and you bring up to the initial condition, like a tab or the roads, stuff. So repair and maintenance, insurance, property tax, mortgage interest, everything is deductible because that's helping you to get that income. Okay, so that are always deductible. Is like a question is not that its expense is not deductible. Question is, are you treating, you are not living in this house, you cannot say it's my principal home. Okay, if you are flipping, that means it's not your capital gain transaction, it's a business transaction, because you are targeting your buy and sell as a business income. Okay.
Yeah, but in case of you're living in a house, you are paying mortgage for 4 years, then you sell it a house, would you get a capital gain on it?
The house you live in is exempted. Whatever will be the capital gain, it will be covered with your principal resident exemption.
And for
the investment property, yes. So for example, if you bought a property and you are renting, so day-to-day expense, your mortgage, interest, your insurance, property tax, everything you can deduct against the rental income. Now if you are selling, at that time already whatever you pay mortgage, you already deduct to cover up your rental income. Okay, But now whatever you have, agent fee, closing fee, mortgage broking fee, okay, those are your expense. Any major renovation you did to sell it, staging and stuff like that, okay. Another thing is that we have to very careful, if you have a property, you bought an apartment and you have, is vacant, it's not rented. You were looking for tenant 2 months, 3 months, 6 months, now say, okay, let me sell it, okay. So if you will be filing, those expense will not go against your rental. You cannot say, oh, I was trying to rent, I was not able to rent, so you cannot claim those as a rental expense because property is vacant. When property is vacant, all the expense on the vacant property is built to the adjusted cost base. So when you will sell it, you will claim that, okay, I bought for 100,000 this apartment, and all this 1 year it was not renting, I was paying mortgage, I was paying insurance, like it's a 30,000. So now your costs become 130,000. Okay, we have to differentiate. Yes, because it's a vacant. But when you are renting, all those expense will compensate your rental income.
And the capital gain rate is the same as that, beside the 50% deduction, is the same as the normal income?
See, people think like capital gain tax is some different tax. Capital gain is mean I bought something for 100,000 and I sold for 200,000. I made 100,000, okay, and those 100,000 is my capital gain. 50% is taxable, meaning 50% of capital gain will be not taxed. So I left with 50,000 taxable capital gain. Okay, now it will come to my income. If my income is 100,000, that tax will be taxed on the 29%. If my income is 0, that capital gain I might be paying 15% tax. Basically, this income is jumped to your income. Whatever income bracket you will be in that year, it will be. That's why we are saying don't sell all your properties in 1 year. Okay, don't do everything in 1 year because you will go jump into higher income bracket and then your tax will be higher. Itself, there is no rule for that. Like for corporation, active business income is taxed on the as a low rate, but passive income is taxed on the 32%. Okay, if my company is a holding company which hold the shares, okay, so whatever the income I make, it's taxed on 32% rate. But if I'm just accountant and making money, my tax rate is around 15%. Okay, so corporate tax rate is flat until 500,000. Okay, but there is a difference that your income is active or passive. Okay, but for individual, there is no differentiation that you have different tax rate for capital gain or business income or employment income. Everything go together, and whatever the tax rate bracket, it will be taxed. And people take the tax bracket like, oh, if I will cross 55,000, I will be paying second bracket tax. No, if there is a brackets, and now they increase even the bracket limit as well. So for example, if my income is 100,000, first 56, 57,000 will be taxed on the first bracket. After that, to up till the second bracket, that income chunk will be only taxed in the second bracket. Yeah, so it will be like that. It's not that $1 make me in the second bracket. Okay, it will be accordingly. So that the year you make 100,000, if you have a capital gain of 10,000, almost all will go in the tax. But in the year when you have no income, that might be not giving you a penny in the tax. So you have to plan like that. So many people, they try to do when they are lay off or something, they said, okay, this year let's sell the property because my income tax rate is lower this year. So there is a basically different things you can do with you. Yeah.
Thank you.
Yeah. Any other question? Yeah.
Will you touch on any software or any planning tool that you can do during the year, so when time comes to file your taxes, all your documents are compiled properly, you're not looking all over the place? Is there any software or anything you can suggest other than those Turbo or those? I'm not.
So basically, TurboTax or InTrofile or Tax Prep or CanTax, those are the filings. Okay. So we used to go to the Canada Post and get the T1 and fill it out, income from employment and business, and then calculate this income first bracket. So now software make it very easy. I teach taxation from more than 8-9 years in the St. Lawrence and Seneca College. So when I teach, the people very, like a student get really hard calculating by everything, oh this and that. But with the software, and the reason why I teach taxation, because I want to keep like going, refreshing my knowledge, because software make life very easy. You just put T4 and your tax return, and you will see at the end that your total income line 101 is this, your tax is this. So it basically those tax software is just calculating. You have to just add, and they have a very good spot that you call them, oh, I have this type of slip where I will put it in. So you can just, but keeping your slip for the tax purpose is hard, because most of the slips you get at the end. So if my income is 100,000, if I not report 100,000, how CRA knows? So that's why your employer send you a copy, send the government a copy. So T5, T3, T5008, all these income slips, one copy to you, one employer. You cannot say, oh, I'm not declaring that income. You cannot all year around keep it, because you get at the end, in the February 29 is the last date that everybody should get their slips. So not keeping that, but for businesses, yes, if you have a day you are working and you want to organize your income and expense, so QuickBook and Sage 50 and Simply Accounting, so many software are there which help you to just track it, yeah. But the other thing which is, I put it on my last slide, account, my CRA account is very good, okay, because you have access online, you can watch slips at Canada Revenue Agency, changing anything, any mill, you are here and there. It's a really good thing to just you. And I recommend everybody, student and everybody, to just make my CRA account, put your email notification, any change, you know, you can change your address, you can see your all the slips over there, so you can download all the, like we get a whole year round, so many questions asking for the notice of assessment. We send our clients 10 times in the year, and they again, if they need it, they will not pull from their email, or they even don't save a copy. They call us and say, can you pull our notice of assessment online? So if you have a My CRA account, just go online and you can download it. So that's another thing, was a good to like go over there. Sisters, don't have any question? Yeah. Okay. So
One more question.
yes.
Like if you are retired, and your spouse is also retired, you are on, if you are retired and you are just getting CPP as well as GIS and OAS, so you had no other income, and you have like 100,000 RIF. So how much you can bleed that RIF that you don't come into taxes?
So the thing is that, first of all, like we get a pension is the Canada pension plan, which is whatever we contribute.
That's right.
And it's also depend, like if I born here at the age of 16, 17, I start working, and how high income I was getting and how maximum CPP contribution I was doing, and at the age of 71 I get retired. So my money on my CPP treasure is high, and I get a high CPP benefit. Old age is the fix for everyone, is from the government. We can apply for national supplement for old age, but that is basically when your income is less than 36,000.
That's right.
Okay, so basically if you have a RIF that much in the year, you will not qualify for the old age benefit and stuff. Okay, so national supplement, old age benefit, not national. Old age benefit is up to 76,000 of the income. Don't do with anything with that. Okay, there is a threshold for 75,000 for old age. But national, if you want to add supplement that, with only
GIS, you mean supplement?
national supplement.
GIS?
Yeah. So guaranteed income supplement or sub. So basically, if your income is less than 36,000, then you are only eligible for that. So if you are taking a RIF of $2,000 to $3,000 every month, so basically you will not go. So at this side, you will lose all your pension income from that side. So that's the reason.
Thank you.
Yeah. Okay. So this year I put some note that so many people, they if they are self-employed and stuff like that, they said, okay, at the end when we will file the tax, we will pay whatever our tax liability is. But the thing is that as an employee, we are withholding our taxes. Any year, if you file your tax and you owe more than 3,000 in any, if you are filing your HST, if you are filing your corporate tax, personal tax, anything, and if you owe upon filing more than 3,000, government want you to pay installment, interim payment for next year, okay? Otherwise, they will charge you in installment interest and stuff. And if you miss the deadline or stuff, so they have used to have 5% penalties, now they have a 10% penalty. So we are on the corner of the taxes. Even on 30th April, if you are busy or something, at least you can amend your return after, but at least, or at least some rough amount of your estimated amount owing you. So at least you can save 10% because they increase the penalty this year. That's the one thing. And another thing is that keep record is basically when you sign up for my CR account, it is pretty much the thing is like that, you can do it. And for self-employed business, I said when you are working as a self-employment, this is also very common. People comes to me and say, we want to incorporate. Okay, so many accountants, they rush. Anybody comes, we want to incorporate, the accountant say, okay, let's do it. Okay, so you should know when you should be incorporating your business. If you are self-employed, I recommend initially when you're having a losses, so many people, they are working part-time or full-time and they start their business. So at that moment, don't incorporate, okay? Because initially when you have a losses, it offsets your employment income and you will be saving your taxes. So until you have a positive income, you just don't incorporate. Use those losses to against your employment income so you pay less taxes. One or that. Another thing is that people thinking like incorporation meaning we will be paying less taxes. Corporate tax, I said, it's flat up to 500 and it's less than our individual tax rate. But for example, if you made 100,000 in the corporation and all the money you need for your household expense and you draw everything as a salary, then what's the difference between? So in corporation, we recommend when you have that much high income that you don't want to take it everything at home. So you are making 3,000, 4,000. As a self-employed, you don't want to pay tax. You want to park that income in the corporate, okay, and take it after, or maybe invest under the corporate umbrella. At that time, we recommend you have to incorporate. Okay, that's one few things. But again, if you want such sort of business where you want to do the brand building and you have plans for it, then yes, of course, you can go ahead and incorporate. But those are the few things where we suggest like you can just wait it. Another under the corporate, we have life insurances, okay. People, when I got or somebody get a life insurance as a personal name, the premium is not deductible because it's your personal. But if you have a corporation structure and you are a director, if you are taking the life insurance under the corporate, okay, even though premium is still not deductible, okay, it's still not deductible, but the thing is that you are still, it's adding up to your income. So it's in the corporate, whatever the premium is, you are paying taxes. But it's always but you are paying through it's adding back to your income, but you are paying less tax on there, only 15% of that. If you took the salary and pay the premium, you will be paying higher taxes. But if you will be buying the life insurance under the corporation, it will be saving you that one thing. And if there is a positive big equity in the corporation, you can always work in the CDA account a little bit more estate planning with your life insurance and stuff. So basically, that's what I explain. And if you guys have any question, I'll be happy to answer. Yes. Yeah, they are bringing the.
I moved from Quebec to Ontario. Where should I file my taxes, both federal and provincial?
Okay, so it depends on December 31st where you will be resident.
In Ontario.
In Ontario, so you will file the taxes as an Ontario. And it's good because Quebec taxes is really high. Okay, high. Yeah. So if you work and you have a T4 or something, okay, so you will see as a quite of the big high taxes you paid. But you will select the residency in the Ontario. On December 31st, if you were in Ontario, so you will be paying Ontario taxes, not Quebec taxes. Federal is same for everyone, but the provincial rate is big difference with the Quebec at least. So it will be Ontario taxes, and you will claim back what extra taxes you paid in the Quebec.
Okay.
Yeah, in the T4, when he will enter, taxpayer enter the T4, down there is a column where you put what the box E of your RL1 slip will go there, which is the extra tax for Quebec. So basically you will get back. So you will be paying less tax and you can file as Ontario taxes. Yeah.
And second question, I have incorporate. I have an incorporate registered in Quebec. And if I want to register here, should I be doing Canada-wide or provincial-wide?
So if any other province you have, like I suggest whenever people incorporate and they have a plan to move around, I suggest to incorporate federally, okay? And then whenever this province they live in, they just get extra provincial registration with that, okay? But if you have a Quebec corporation, I will ask if you close it down, okay, and or you can always get the extra provincial registration in Ontario. So based on your residency, okay, you are the management director. So this is a permanent establishment. Now your permanent establishment is with Ontario. So your corporation, you will get extra provincial registration with Ontario. So you will be, that corporation will be considered now the Ontario corporation. If any time you want to incorporate a new corporation, I'll say like always prefer the federal. One thing is that if I register my corporation, Ruqayya Khan CPA Professional Corporation, now I move to Alberta, okay, so I have to do the name search again. And might be this name will not be available over there. So even I will not be able to get extra provincial registration, okay. So when I incorporate federally, my name is federally approved. Whatever the province I want to get the extra provincial registration, it will be easy because they don't have to do the name search because the name is federally approved.
Yeah. This is what we did. Like I had federally registered here in Ontario, then I moved and we did it provincial, and now we moved back here. So they're saying like do provincial.
For the
again.
same company, you got extra provincial registration in Quebec. And now you get back extra provincial registration in Ontario.
And I have to pay all the fees again?
Yes, Ontario fee is not that much.
Okay.
Other province charge high, Ontario. Even when we incorporate federal, right away we can get extra provincial registration in Ontario without any fee. So Ontario ministry fee is less than like a, yeah. So you can get an extra provincial. See, our tax have two levels, federal tax and provincial tax. Federal tax is like everybody has to pay. But every province say, oh, we have a right on this income. So whichever the province that income you make with permanent establishment, that province has a right. So for example, I am here and I am filing so many taxes for people in Quebec, people in British Columbia, Alberta. So my corporation is still Ontario corporation and my income is still considered Ontario taxable income because I don't have permanent establishment on those province. Business income matter that who pay tax, which province has a right to tax is where the business has the permanent establishment, PE. Where is the management? Where is the office? Are you have any direct employees hired in this province? Okay, those make you have a permanent establishment. Then that province come to you and say, oh, you have to pay us a tax because you have a permanent establishment over here. Okay. Yeah, so that's the basically. Yes.
So would that be taxable? Like it comes the check comes in the children's name.
Okay, so for RESP, so every year government change. Okay, so if your kid's born here, they said initial when you open up RESP account, they will give you this much, and after on your contribution they match this, and they have the okay until they go to the post-secondary education, they will max up to 5,000 or 10,000, whatever, under your kid's RESP account, okay? So it's how it works. For example, you put it 5,000 and the Canada Revenue Agency or the government has 3,000, okay? When your kids go to secondary education, you draw the money from RESP. The 5,000 you added, it will be no tax for you because that was your money. The 3,000, the government grant in RESP will be taxed on your kid's name. They will get T4A slip, okay, which show that they withdraw the RESP, okay, but because they are just a student, their income, first 15,000 we are not paying any taxes. Our basic exemption cover our tax on first 15,000 of our income. So that's my kids are not paying any tax. Okay, so that's the RESP program. Only for the RESP, you have to be careful whenever you go for any financial institution, you just double check. If you are okay until the kids go to the secondary education, you are fine. But if you break it, you have, for example, if you are moving to any other country and you break your RESP program or something, at that time, these financial institutions have they charge such a high administration cost that whatever your amount of contribution is just go. So always be careful when you are contributing an RESPs. If you are fine, everything is, just keep it that plan if you open up. If you want to break up, they will take all your money under the charges and penalties and stuff. But your kids will get the slip for the T4A and it will be not taxable at all. Okay. Okay.
Samkum, I have a question. So if someone starts temporary, like they go to US, for example, for a temporary work permit or whatever. So when should they start the tax-free saving or the first home saving account? Should it be right now or should it be after they come back from their work?
Okay. So see, Canadian tax and benefit all apply on residency. Okay, it doesn't matter you are citizen or PR or whatever. Its tax system is based on residency. If you break your ties with Canada, saying, oh, I'm moving away with my family, my spouse and stuff, moving to US, means you broke the residential ties. At that time, if you already have a RRSP, TSFA1, if you can keep it until the age of 65 and draw, but you cannot put it anything more in there. Okay, so that's why you cannot put it unless you come back. Okay, so that's why, because it's based on the residency. Because this RRSP plan is like whatever the return you are earning, whatever on your contribution is tax free until you withdraw. That's why when you freeze, go no tax, because it's when you draw, then it's taxable. But you cannot contribute anything more. So when you come back, and at that time you have to decide. So many people, when they plan to go US and stuff, the tax rate is very lower than Canada. So we recommend that you take your spouse with you, break the ties, become a non-resident, because it's not have any impact on your PR or your citizenship. So just become a non-resident and then come back, because then why you don't have, because as a Canadian resident, if I say I'm resident, so I have to declare my worldwide income and pay taxes. So first file the return in the US, pay taxes, then show the same in the Canada, whatever the difference of the taxes you have to pay. So non-residency, and once non-resident, you cannot contribute in RRSP and stuff. Yeah, yes.
Assalamu alaikum. So for a student, like high school students, if he started work this year, shall he file the taxes with the family, or he has to do it on his own?
Okay, so basically everybody file their own taxes. If you and your husband go and file taxes, it doesn't mean there is something joint. Okay, everybody's file their own taxes. Okay, every return is separate. Your son, everyone. Only we make a combined file to transfer the credit. For example, everybody first 15,000 of the income has no tax. Okay, if I have a 15,000 income, my basic exemption 15,000. Okay, cover up my first 15,000 income. If my income is 40,000, but my husband income is 0, so I will save tax on my 15,000, and my spousal credit will also transfer to me. That's why we make a family tax. Okay, even if somebody says, okay, my wife want another accountant, husband has another accountant. If the person comes, they married, but they come alone to file their taxes, they are filing separately in the way that they like their own accountant. We said, okay, ask your wife what's the income, line 1500. So we just want to add, if wife income is 0, let's claim the exemption from here. Otherwise, everybody's tax. If your income is 40,000 or your husband's income is 300,000, you are paying tax on 40,000, he is paying on 30. There is nothing like a relate. And kids are also, when they are under the age of 18, you get their GST and Trillium benefit if your income is low. Okay, when they cross that age, they file their own taxes, they got their own benefits. They file and they get the GST. For example, if my income is 100,000 and I don't get GST, Trillium benefit and stuff, but if my daughter, when she becomes 18, she file her taxes, she get her Trillium because now she is on your own. Okay, so no taxes are related like they. We just make a combined file, we transfer the kid tuition to parents, we transfer the spousal credit to each other who need it, disability tax credit, like those stuff. But there is no difference. Even husband and wife can have their own accountant and go, only we need their line 1500, the income. So we just declare to claim if we can, that's it.
Thank
Yeah,
you.
okay. Yes.
So this is about RESP. If a student after finishing high school intends to go out of the country and all 5 years the RESP that's being done, like provided, how to claim that, or how is it going to influence if he goes out of the country for studies?
For study, he can still claim.
Okay, like
if he goes to foreign institution for study,
yeah,
it's the same way. You can claim OSAP, you can apply for OSAP, you can apply for tuition credit, whatever tuition fee he paid over there, and you can withdraw against the RESP. It's not conditional that he has to go to the Canadian institutions.
Okay, fine. So would you just brief a little? Once the high school is finished, do they provide the RESP, all the payment the same year of finishing high school?
You can take out all the thing, but it's mandatory that he must join the post-secondary education. That's a mandatory. If I'm taking a 1 year off after my high school, they will not release, because admission in a post-secondary education is mandatory. And that's why if somebody, like some kids, they don't go, then they wait until the age of certain limit. Okay, if that passes, then you can see if you can withdraw that amount, but then it will be taxed on your hand.
Okay, okay. And how much they are going to provide? You mentioned like after high school the RESP, and then on top of that the government pays?
So for every year the government changes the rule. They give, okay, so if your baby born this year, they said, okay, if you will open up this year RESP account, on your first deposit will match 5,000. Okay, and over the age he go to the secondary, the maximum government do 10, 15, every year they change. But the rules different comes every, like they were used to get only 5,000, but now they are 10, 15,000 they match. But whatever the government grant is the taxable, but under the student hand. Okay, whatever your contribution in that plan, you get back under your hand. It's not, because it's your own contribution.
Okay, fine. Yeah.
But they must go to the post-secondary education to break that plan.
Even after, if the child wants to take a 1 year gap and then?
Yes, yeah, he has to wait.
Okay, fine.
Yeah, and but there is no condition that he go to the Canadian institution. You still can apply for the OSAP, you can still claim the tuition credit. There is we have tuition slip T2200, T2202A, but if your kids go to US or UK or whatever, they have TL11. They file their taxes and they file their tuition credit, same as there's no difference that they are going Canadian institution or, yeah.
Sister?
Yes.
Sister here.
Yes.
Assalamu alaikum. You said that if you're self-employed, you prefer that there should be no incorporation, or it shouldn't be incorporated. So then what's the option for self-employed people? How would they handle this?
So for example, I got one time a client, a girl, she got married, she moved here, and she wanted to just import some goods from the Pakistan, just like a spa, nail cutter and filer and stuff. She went to the accountant and he said, oh yes, you have to incorporate and this and that, whatever, a few $100 of worth of things she was coming. No, she has no intention from brand making, something business or something. So incorporation cost plus accountant fee for filing, plus whenever you make anything under the corporation is corporation income. If you are drawing money to you, you have to have as a salary arrangement, okay, employment. So lots of work and fees. So that's why we said if you are doing like a home-based catering or daycare, so work as a self-employed, okay. So that's the better. We said like until you have like, if my income is in corporation is 30,000 and I need 30,000 to pay my rent, okay. So there is no saving if I'm making money in corporation or as if, because I'm taking all the money home. But if I'm making 300,000 and I only need 100,000 yearly for my household expense, so yes, then 200,000 is corporate tax at the low rate for 200,000, and I'm putting in the corporation, maybe investing under the corporation and taking only 100,000 to pay higher tax under my hand. So that's the few things we which just work with.
Okay, thank you.
Yeah. Okay. RESP no tax deductible. RESP. For your side, no, but there is a maximum government contribution is fixed. They just go up till the level. Yeah. Thank you. No problem. Anytime. Thank you.
Thanks for coming, and please send your feedback.
Yeah.
We need your feedbacks always. And what do you want to see next? Send that too. Jazakallah, and hope to see you soon. Assalamu alaikum.
Now on my own business, I'm still paying. तो अब जैसे आपने कहा कि हमें उसमें से पैसे निकलवा लेने चाहिए, तो अपनी जब इनकम वो उतने पैसे निकलवाएं जितना वो डिफरेंस है कि हम नेक्स्ट ब्रैकेट में ना जाएं.
जैसे आपका जो भी अकाउंटेंट होगा, तो आपकी सारी सिचुएशन उनके पास होगी कि मेरी इनकम है आज इस दफ़ा आपकी 60,000 है, 70,000 है, तो अगर आप TF RRSP से पुल करते हैं तो कितना टैक्स है, तो फिर उसके हिसाब से मतलब प्लान कर ऊपर. हाँ, लेकिन मतलब अकाउंटेंट के साथ मिल के भाई इतना है तो उसके हिसाब से. या वालेकुम.
So basically I'm on disability or DSP.
What DSP?
I recently applied for disability tax credit. I got approved.
Oh, yes.
They said they're gonna, in 2 months, they're gonna send me T1. So should I wait for the T1 to do my taxes, or can I do it now?
So basically, if you approve for the disability tax credit, the time period you are approved. So disability tax credit is also, it's reduce your tax liability. For example, if you have a disability tax credit but you are not working, so it's useless for you because it's reduce your tax liability and you already not make it.
But I get like 650.
Oh, okay. So you are asking for that. The government is paying the ODSP. Etc. So they basically they will send you mail, or you have, if my CRA account online, their slip will be already in there.
So I have to have it to do my
taxes. But usually, when you go to your accountant can pull your account online and they can see, because the government slips is already up.
Can I come to you?
Yeah, anytime. Yeah, I'm just close by, so anytime. Yeah, okay.
Last year my dad passed away, so he left some assets in Pakistan. So some of the property, some are liquid, some are shares, and he has some shares in the business. So now this year I'm going to declare them. Are they taxable?
Your dad was here?
No, he was in Pakistan. He wasn't here.
So if he was not here, his asset, nothing is taxable. The only thing is that if you are bringing it, okay, here, so you said, oh, it's inheritance. So inheritance is tax-free for you. For example, if he was here and he passed away and he has all the property over there, then that's capital gain. But if he was not here, he has nothing to do with Canadian taxes. Only when you bring that money in, you have to tell the bank that is my inheritance.
Okay, but someone told me that you have to file a certain form of overseas. Now you have inherited this year, so you have to file something.
Nothing. See, if for example your dad is alive and he gives you one property on your name in an inheritance. Today's date, the value of the property, okay, is 100,000, and he gifted to you, okay. After 2-3 years, you sold. Now it's 4-5. So once you got the foreign property more than 100, then you have to declare foreign property, and when sell it, capital gain. But in this case, you are getting just the dividend, like inheritance.
We just passed this.
Yes, yeah.
Thank you.
No problem.
Just wanted to meet
Walaikum
my name
assalam.
is Fareed Parishirkar. So I'm your client, basically.
Yes. Oh yes. Now I got to know. I see. You are announced. That's good. We never meet. Like yeah.
So I'll take appointment inshallah and for this year.
Inshallah. Inshallah. You are already client. I just.
Just one question. Like I have incorporation as well.
Yes.
So less than 15,000 is not taxable, right? In incorporation.
No, that is a credit for the. That's credit for the personal taxes.
What about incorporation?
Incorporation flat rate, but all that they don't have the credit. But you can claim the expense.
Okay, but
home office expense.
Like, let's say 3,000 or 5,000 only.
So we can claim home office expense, telephone, internet.
I
That.
withdraw all the amount to my personal account already.
Yes. Okay.
So we can claim to
We can claim it too. That's right. Inshallah. Okay. Nice seeing you, brother. Inshallah.
So my question was, when we're doing our taxes, can we claim like payments that we do towards like eye exams and glasses?
Okay. So how medical credit work? Okay. If for example, if your income is less, so even you are paying for medical is not saving you. Okay. Medical credit reduce your tax liability when you have to pay taxes, you have a taxable income, plus your tax, the tax medical bill must be more than 3% of your income.
Oh, okay. Okay.
Until less than 3% of income of your, so for example, if my income is 100,000, so if my expense is 2,000, no benefit. It's supposed to be more than 3,000 or at least threshold 2,400.
Would that also include like my dependents, like my children?
Yes, you can put it in, and it create the credit, not deduction.
Okay. Also, like my employer, like he's matching RRSP. So does that take away from my contribution limit or no?
Yes, yes. That's why on your T4 box 52 shows to the Canada Revenue Agency, for example, if my room is 50,000 and I want to contribute something, whatever the retirement pension plan box 52, my limit will be reduced. So your RRSP limit is used by you and your employer for RPP.
Oh, okay. So we have to make sure we don't go over it.
Go there.
And then the other thing was that they sent me some forms, and it was like personal tax credit claim was like 12,000, and Ontario federal claim personal amount was 15,700. And I was like, what is this? I don't know.
It's a TD. So for example, when you got a new job or any job, they send you TD1 form asking to fill, they want to know which bracket you are. So they estimate tax and withhold upfront. Okay. So for example, you say, oh, my son has a disability, I have a disability credit, my husband is not working, I have a spousal credit. So that's why they estimate and they take a less tax from you. Okay. So for example, if they take too less tax from you, and then when you will file, you have to pay. And if they take too much of the taxes, then all the year you are struggling with your household expense, but at the end you are getting refund. So TD1 form they give you and saying, okay, if you are working more than one place, so you know that your basic exemption will not be available. So they try to estimate which tax bracket and then how much withholding taxes. That's why they give you this form.
Oh, I see. Okay. So it can change based on like.
Yes, I recommend just if you have only one job, just add basic exemption 12,000 or 50,000. That's it. Don't add anything else. No tuition credit, nothing. Right. If the tax will be little bit more and up, it will be back though. But if they take less tax, upon filing, you have to pay taxes. Okay. So at that time, people don't like to pay taxes. Okay. Yeah. So that's why. Yeah. Okay. Yeah. Walaikum assalam. Yeah.
If you have a PR and you haven't worked yet, are you still filing for tax?
Yes.
So how does that work? Since